Welcome back to the channel today. We're diving deep into one of the most powerful and disciplined investors of our time, Warren Buffett. If you think you know everything about his strategies, think again. In the past year, Buffett has made moves that are shocking to many, selling massive amounts of equities, halting stock buybacks, and hoarding cash like never before. He's been a net seller for 10 consecutive quarters, yet the way he positions himself now could be one of the most important signals for any investor trying to navigate today's market. We'll break it all down: what he's selling, why he's hoarding cash, how the market is dangerously concentrated, and where the hidden opportunities lie. By the end of this video, you'll understand why Buffett's actions are not just random. They are a masterclass in risk management and strategic positioning. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the numbers. Over the past year, Buffett has sold roughly $143 billion worth of equities, while buying only about $9 billion. One of his biggest moves was reducing his position in Bank of America by 41% and stopping all stock buybacks, the first time he has done so since 2018. Meanwhile, he has increased his cash reserves from $167 billion to a staggering $348 billion. This is not the behavior of an investor who is blindly bullish. It's a calculated defensive maneuver. Remember, Buffett's entire fortune was built on buying quality businesses and holding them forever. So when he suddenly starts unloading assets at scale, it's worth paying attention. Buffett's philosophy has always centered on investing in companies with enduring value. Yet here's the twist. The man who once famously said, "Be greedy when others are fearful," is now holding enormous amounts of cash at market peaks. This is a signal, a red flag for anyone trying to understand market sentiment. If the Oracle of Omaha is hoarding liquidity, it's a cue to step back, reassess exposure, and decode the risk landscape. The first major warning comes from what I like to call the concentration trap. Currently, just 7 companies, Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia, control about 34% of the S&P 500. Let that sink in. Roughly 1/3 of what you think is a diversified index is actually tied up in just 7 stocks. The illusion of diversification is deceiving investors. Since late 2022, these 7 companies have been driving more than 50% of the total gains in the index. Remove them and the S&P barely moves. This is math, not opinion. Think about the downside risk. A 40% correction in these mega-cap tech stocks could automatically trigger a 15% decline across the entire S&P 500, even before panic selling begins. Add human emotion to the equation, and the losses could snowball, potentially devastating retirement accounts and individual portfolios. Essentially, we're looking at concentrated tech speculation, dressed up as broad market exposure. The valuations themselves are extreme. Take Tesla at 263 times earnings, Palantir at 700 times, and Nvidia at 90 times. The S&P 500 average currently sits around 29 times earnings, while the historical average is closer to 16. To put 700 times earnings into perspective, a company would need to increase profits 35-fold, assuming zero competition, no regulatory changes, no technological disruptions, and flawless execution for decades. That's practically impossible. An MIT study even analyzed $30 to $40 billion in AI infrastructure, and 95% of companies generated no meaningful returns. The market is pricing imperfection, while history tends to deliver chaos. Multiple market indicators are flashing identical warnings. The Buffett indicator, market capitalization relative to GDP, is at 225%, a level that appeared only twice before the dot-com bubble of 2000 and the financial crisis of 2007. Both events resulted in declines exceeding 50%. The CAPE ratio, cyclically adjusted price to earnings, is above 40, a threshold only crossed during 1929, 2000, and 2007, all preceding catastrophic crashes. Market concentration in just 7 stocks now surpasses even the Nifty 50 bubble of 1999. Every major alarm is sounding simultaneously, yet most investors remain oblivious. While growth stocks soar to irrational valuations, there's a hidden opportunity in quality dividend-paying companies. For example, the Schd ETF, Schwab U.S. Dividend Equity ETF offers a stark contrast. SCHD trades at about 17 times earnings, well below the S&P 500's 29 times, and yields 3.8% annually versus the S&P's 1.2%. A $100,000 investment in SCHD generates $3,800 in annual dividends versus $1,200 in the S&P 500. That's triple the income. SCHD's portfolio focuses on companies with a proven track record of consistent dividends, firms like Coca-Cola, Pepsi, Chevron, Pfizer, Cisco, and AbbVie. These are not risky startups burning cash. They're established cash generators that have survived economic depressions, world wars, financial crises, and every market downturn. SCHD companies have increased dividends for 12 consecutive years, with annual dividend growth of 12.2% and 56% lower volatility than the broader market. Even during 2022, when the S&P 500 dropped 25%, SCHD only fell by 15%. That 10-point difference can be the line between panic selling and staying invested. Over the past decade, SCHD delivered 11.6% annual returns versus the S&P's 13.7%. Sure, it slightly underperformed during the tech bubble, but it achieved 85% of the returns with only a third of the volatility, along with steady income. Risk-adjusted returns clearly favor dividend-focused strategies. So, how should investors act? There are 3 tactical moves to consider. Allocate 40% of your portfolio to SCHD or similar dividend-focused ETFs. Automate monthly purchases to dollar cost average, collecting 3.8% income while staying exposed to market growth. When markets rise, you participate. When markets fall, you buy more shares at lower prices. Hold 15 to 20% of your capital in cash or short-term treasury bills, yielding roughly 4%. This mirrors Buffett's approach. He hoards $348 billion to deploy during fear. Set predetermined buy triggers for market drops, such as 10%, 15%, or 20%, and deploy systematically rather than emotionally. Steer clear of stocks trading above 100 times earnings. Avoid overlapping index funds that create a false sense of diversification. Be wary of pure growth plays with no income and zero downside cushion, and don't chase momentum in concentrated sectors. Historical precedent is clear. After the dot-com crash, value outperformed growth for 7 consecutive years, and dividend payers stabilized portfolios, while speculative stocks collapsed. The lesson is simple. Mean reversion is not theory. It's mathematical certainty. Human behavior never changes. Current market conditions mirror previous peaks, extreme valuations, record concentration, institutional distribution, and retail euphoria. Your portfolio now faces a binary choice. Option A, continue holding mega-cap growth stocks at valuations that preceded every major crash, hoping this time is different. Option B, shift to cash-flowing, dividend-paying companies at significant discounts, collect stable yields, and prepare for inevitable market corrections. Buffett chose the latter. Institutional money is rotating defensively, and dividend-focused ETFs like SCHD provide exactly what is required for survival: proven companies, discounted valuations, steady income, and lower volatility. The current valuation gap is enormous, and disciplined investors who prioritize fundamentals over hype will benefit as the market eventually recognizes the disparity. Wealth is not built by chasing the next tech sensation. It is preserved through discipline, patience, and strategic positioning. When others panic, billionaires like Buffett position defensively. Data validates the risk, and opportunity is directly in front of you. Your allocations will determine whether you survive the next major correction or get caught in another speculative collapse. The market today is a test of patience and discipline. Buffett's massive cash reserves, the extreme concentration in 7 mega-cap stocks, and the historical warning indicators all signal caution. Yet within this risk lies opportunity. Dividend-paying, fundamentally strong companies trading at decade-low valuations. By allocating strategically, maintaining liquidity, and avoiding speculative traps, investors can protect their capital, generate steady income, and position themselves for long-term gains. Remember, wealth is preserved by planning and discipline, not hype. The choice is yours. Follow the crowd into high-risk speculation, or follow proven strategies that have weathered every storm in modern market history. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.